Hey, what is going on, everybody? Welcome to our brand new channel, Financial Digest. On this channel, we're going to be exploring the world of finance, ranging anywhere from financial statements all the way to the upper level financial concepts. Today, we're going to be looking at how to become an investment banker. This is an extremely sought after position, and a lot of people would love to become one but don't know all the things that come with it. So, without further ado, let's get into part one of becoming an investment banker, and that is looking at financial statements. Now, before you can become an investment banker, you obviously have to have a whole plethora of knowledge that you can pull from. And that begins with understanding the financial statements. The very first and most basic financial statement is something called the income statement. This is a little piece of paper, really, that just shows all of the company's sales and costs. And then in the end, it gives you something called a bottom line, which is your total income. That total income is really your sales less all of the costs over that period. So some of the costs that it's going to include are going to be things such as cost of goods sold, which is what it takes to make the product or service that you're outputting, operational expenses, which are things such as selling expenses, general and administration, depreciation and amortization. Depreciation and amortization, by the way, is just a very complicated concept, but it's in total, it's just the loss in value over time of a certain entity, usually whether it be equipment, buildings, etc. There are also other expenses, such as the interest expenses, different write-downs, things that are not directly tied to the regular operations of the company, and then there's taxes. Now, on an income statement, it's split into the four main sections. So the top section, which we'll see in this next slide, is going to be the revenue and the cost of goods sold, which is going to output your gross profit. After that, it's going to be that gross profit less your operational expenses, which is something like your SG&A and depreciation. After that, you're going to get into the other income and expenses. So you're going to have that operating income, and you're going to subtract those other expenses such as interest, different write-downs, and things that are not directly tied to the company. And lastly, you're going to have that pre-tax income, and you're going to subtract your taxes. And in the end, that will all output your net income. The net income is extremely important to investors because it shows after everything, is the company profitable or not? And that's what investors are going to be referring to in terms of profitability. A quick rule of thumb is that items must affect companies' taxes and correspond only to the period that you're looking at in order to be on the income statement. Usually, on an income statement, it's going to be either annually, which is 1 year, or quarterly, which is 3 months. Also, every item that is going to be on the income statement is going to affect the company's taxes. So if it is not correlated at all to a company's tax and does not lead to a tax deduction or exemption, it will not be on the statement. So now let's look at a quick example of a very, very basic income statement. So right here, I've put together a really, really basic income statement for company X. And this is kind of the general format of what an income statement might look like. It'll have the revenue on the top, and then slowly it'll have the expenses be kind of called off, and then at the very end, it's going to lead to that net income. So as we kind of just covered in the last slide, it's going to be your revenue. You're going to have your cost of goods sold, which is going to lead to your gross profit. And then you're going to have your operating expenses. This is usually going to be a much more in-depth kind of review of what operating expenses are. We only put operating expenses in total, but then that will lead to your operating income. It'll then lead to your non-business activities, and that's going to be things like your interest expenses, different impairment charges, write-downs, whatever it may be, and that'll lead to your pre-tax income. Later, it'll lead to your taxes, which will be taken off based on the tax rate at the time. And then, as I said, that'll lead finally to your net income. And again, that net income is extremely important. Something that's really cool that a lot of financial analysts do is they do something called common sizing. In order to compare companies, they will find percentages of all these. So for example, I would take my gross profit and I would divide that by my revenue in order to find my profit margin. And that, as you can see, if you divide the 40 by 100, that's going to be 40%. And you can use that to compare across companies and see and gauge which company is better in which segment. So now we're going to look at another financial statement, another very, very important one called the balance sheet. So this next statement is called the balance sheet. And the balance sheet shows your assets, liabilities, and equity. These three things will show the entire worth of the company. And so to differentiate these different things, we have assets, and these will usually result in additional cash for the company. That's kind of the definition of an asset. But really, something that's really helped me understand it is that assets are the resources of a company, right? These are things like cash, receivables, which means that somebody owes you money, different investments that you've made, property that you have, equipment. You'll have things like liabilities, and these are things in which you owe money. It results in a loss, and these are things like payables, which you owe something to somebody, debt, accrued expenses, and then you lastly have equity, which is ownership of the company. And this is things like common stock, which I'm sure you've heard of. There's different types of stock like preferred stock, treasury stock, and then there's additional paid in capital. And like I said, assets are the resources, and then liability and equity shows who claims those. All right, now the equation at the top, the reason I put that in bold is because it's extremely important and it's always going to be true. Assets are always going to equal your liabilities plus your equity. And now we're going to really quickly go over a very, very dumbed down example of how this kind of applies. So pretend I am looking to buy a house. I have $100,000 and that would be my assets, right? I'm going to buy that house, so I go to a bank and I'm like, okay, I want to take out a mortgage because that's usually how you would buy a house. You don't obviously just put all your cash out there because then you have no more cash. But so I'd go to a bank and let's say I asked the bank to lend me $80,000, which is my mortgage, so then I can start paying it off for my house, and then I'll have a $20,000 down payment. So think about that. My asset now, I just bought the house, is $100,000 because that's what it's worth. My liabilities are $80,000 because that's my mortgage. That's what I need to pay off. That's what I owe to the bank. And then my equity is my down payment. It's what I own. I own 20% of that house or $20,000 of that house just by kind of doing the down payment. So try to just kind of work that out in your head. If you have to write it down, it really helps. But even if that doesn't make sense, really just try to memorize assets are always, without fail, going to equal your liabilities plus your equity. Now let's look at it very, very quickly, a constructed balance sheet. All right, so I've put together a little balance sheet right here. It's obviously a little longer just because it has more accounts, and the accounts are just the things down the left-hand side. So again, it's got a very similar format, but in this case, instead of having the revenue and then the costs towards the bottom, it is separating the assets, liabilities, and equity. So we're gonna have our assets on the top, and it always goes from most liquid on the top to least liquid towards the bottom. That means in terms of liquidity, it means which can be converted most easily to cash. So cash, obviously being cash, is the most liquid thing you can have. So that's gonna be on the top in your current assets. And that's gonna have a whole bunch of different accounts, and that's gonna lead probably to inventory, which is not very liquid because you would have to sell that off. All of those are going to be in your current assets. Current is always just going to mean less than 1 year, and that'll kind of make sense as we move throughout these videos. But we're going to have our current assets, and then we're going to lead into our long-term assets. This is going to be like plant, property, and equipment, different long-term investments, whatever they may be. And then when we add our current assets and our long-term assets, that's going to make our total assets right there, right in the highlighted yellow. All right, now in the next section, we're going to have our liabilities and our equity. In the liabilities section, we're going to, again, very similar format to assets. That's going to be our current liabilities, and that's going to be things such as revolver. Revolver is really just short-term debt. If you ever see revolver, just think short-term debt. And then we're going to have our long-term liabilities, and again, very similar, long-term debt, deferred revenue, whatever it may be. And if you don't understand what these are now, we're gonna get very specific with it later in the next video. But then if we take our current liabilities plus our long-term liabilities, that'll give us our total liabilities. Again, we need to add in our equity. Our equity is going to be our common stock, treasury stock, whatever it may be. We're going to add that, all of our equity together. We're then going to add that total value to our liabilities. So then it's our total liabilities plus our total equity, and that's going to output the highlighted number at the bottom. And again, make sure that the two numbers, the total assets and the total liabilities plus equity, always equal each other. Now we're going to get into the last and most important financial statement, which is the statement of cash flows. All right, so our last financial statement that we're going to be looking at is the statement of cash flows. And this is the most important of the financial statements because it shows how and where cash is moving throughout the company. There's a kind of a really famous saying, it's not famous, I guess, but it's very well known that cash is king, right? This is the lifeblood of the company. So it's very, very important to understand where cash is moving and how it's moving throughout the company. So the cash flow statement is much more complicated, but it's split into three parts. The cash flow from operations, which is your cash from some of the core business activities. All right, that's going to be like your cash from sales, your net income, everything like that. Pretty basic stuff. Just think core to the business for operations. We then have our cash flow from investing, and that is cash that's used to buy into some of the future investments, such as more capital. When you buy more capital, again, this is something called CapEx, which if you don't know what that is, I'll explain in a later video. We have buildings that you've made or that you've purchased, or if you have different acquisitions that you're going to make, it's anything in which you want to invest your money and get something out of it in the future. And then lastly, the third part is cash flow from financing. This is cash that's going towards how the company finances themselves through things such as debt, the dividends that they pay out, or repurchasing or giving out different shares. These are all ways in which the company is really just raising money and how they're kind of maintaining those relationships. Now, if you add these three sections together, it will give you the change in cash for that period, which is very important because then once you get that change in cash, you can then show that on your balance sheet. So if we go back really quick and we see that our cash in 2019 was $100 and in 2020 was $200, the cash flow statement reflected that change. So the change in cash in 2019 is the difference in those two, right? So the change in cash was $100, and we're going to really quickly look at a dumbed down example of a cash flow statement. All right, so this is our last statement, company X's statement of cash flows. It looks much longer and much more complicated, and that's just to kind of reflect that it is a little more complicated, but it also just has more accounts that really mean something on here. So to start, we have our net income that was previously shown on our income statement, right? Because these are our operating activities. So this is everything that's core to the business, and obviously net income is all the operations of the business. So obviously that's very, very core to what they do. We then have depreciation and amortization, which we add back. This is the biggest thing that I want you to get from this statement. Obviously, it's not going to make sense right now when you just look at it and you see this mess of information. But the reason some values are negative and positive, I think, is the biggest thing that you need to take away. When it's positive, that means that it's a cash inflow. You're getting more cash, right? And when it's negative, that's a cash outflow. It means you're losing cash. And that makes sense. If it's positive, you're going to add that back, you're getting cash. And if it's negative, you're losing cash. It's leaving the company. So, as you can see on our gain or loss on a sale of PP&E, in that case, it looks like we sold off some of our plant, property, and equipment, and we lost some money on that, right? Or we had an outflow of cash, so it's negative. And just you can kind of briefly look through different statement of cash flows and just see which are negative and which are positive. Some accounts are going to vary based on the company. Also in the operating activities, we're going to have our change in operating assets and liabilities, whatever's core to the company, so our accounts receivable, inventory, how those all change. So again, anything that's core to the company is our operating activities. Then we're going to lead into our investing activities. This is purchasing or selling short-term and long-term investments. I mean, that's pretty straightforward. Our CapEx, which if you don't remember from the last slide, was whatever we bought into in order to further our company. So like if I bought more equipment or if I wanted to buy a new machine, that would increase my CapEx. And the reason CapEx is negative, again, it's an outflow of cash. I'm spending money, cash is leaving the company, so it's negative. And then our PP&E sale proceeds, if I were to sell PP&E, which PP&E is plant, property, and equipment, then I would have an inflow of cash. We're going to add all those up for the cash flow from investing, which I bolded them. And then we have our financing activities. And these are things such as if I were to issue dividends, issue debt, repay debt, issue different shares, repurchase shares. This is all really just how the company's financed. We're going to add all those up, and that is going to be our cash flow from financing. And again, it's okay if they're negative. It is okay, because that just means it's an outflow rather than an inflow. Once we have all those totals, we're going to add the cash flow from operational activities, investing activities, and financing activities to get the change in cash for the period. If you look towards the bottom of the page, we have our beginning cash for the period, the change in cash, and the ending cash. The ending cash is going to be what it is for that year, right? And then, so in 2019, we saw that the ending cash was 100. If we go back, ending cash for 2019 was 100. For 2020, it was 200, and ending cash was 200. So that's kind of the basic statement of cash flows. Obviously, it gets more complicated, and in further videos, we're definitely going to explain and delve into much more of the kind of the grain of a lot of these accounts and whatnot. But that kind of sums up some of the financial statements in general. All right, guys, and that kind of concludes our quick recap of the three basic financial statements. There is another, which is the statement of stockholders' equity. Again, depending on what job you have, it's not very important, and it's not something that we're going to look at right now. But for next week, we're going to be looking at some of the specific accounts in the financial statements. So this is all those different accounts on the left-hand side that I'm sure a lot of you maybe did not understand at the time. We're going to be looking at those and breaking down what they are and what they mean. So before I go, there's three recap questions that I'd love for you guys just to kind of think through in your heads. And that is, can you briefly walk through the income statement? What are the three main sections on the balance sheet? And does the income statement affect the cash flow statement? And if so, how does it do it? So if you can do all those, you're definitely well on your way to just understanding financial statements, and it'll definitely be a great setup for next week. And again, thank you guys for tuning in. I hope you all have a wonderful rest of your days, and I will catch you all next week.